Welcome to this guide. It's gonna be a full tutorial about derivatives in crypto. If you want to learn more about Bitcoin, Ethereum, the real way of trading them, using data such as open interest, cumulative delta, funding rates, liquidations, etc. This is the full guide. Now, if you want to learn more about me, there's gonna be a few links in the bio. If you want to go and check them out, feel welcome to do so. More information in there. Now, what's the plan for today? We're gonna speak about why monitor the data, open interest, delta, CVD, funding rates, and liquidations. Why crypto derivatives data matters? Okay, when trading across different markets like forex, stocks, futures, crypto market is the most influenced one by retail investors, right? So retail buyers driven by FOMO, brief trends, they often drive the purchase of Bitcoin and altcoins. And by monitoring the positions of both small and large traders and tracking shifts in the open interest, you can gain insights of what most likely is going to happen, and this is going to enhance your trading approach. So you want to be looking at all the edges you can gain, and you want to be using the high probability trades, not just random trades. You want to be trading with the best possible edge you can find. So one strategy, an example, it involves taking advantage of major liquidations when traders are being forced to close the position, or engaging in squeezes, using the funding rates. So this can be integrated in the trading strategy, and it can be combined with popular price action techniques. So let's speak about the crypto contracts. So perpetual swaps, often called perps, are most widely used instrument for leverage trading in the crypto market. And while many assume that perpetual futures are a unique concept to crypto, this is not the case. Pretty much they were developed into 1992 to facilitate derivative trading for low liquidity or illiquid assets. These contracts gained traction in the crypto world in 2016 when BitMEX popularized them. And what exactly are the perp futures? Perpetual futures are pretty much similar to the CFD contracts. The difference and are distinguished by the fact that they have no expiry date. Pretty much the traditional futures like S&P, Nasdaq, GC, they do have an expiration date every 3 months. Gold and crude oil, they usually in a month. And while cryptocurrencies often also offer quarterly expiration contracts, they don't match the popularity or liquidity of perpetual futures. And this is often favored by larger traders for delta neutral strategies or long-term leveraged positions, because they have no subject to funding rates. Now the difference between inverse and linear, so pretty much the inverse contract is over here. You do use coin margin contracts, so pretty much to trade any of these contracts you do need the coin of the asset, and over here you do need just USDT as a margin. So this is the difference. One is using coin margin, one is using USDT. The main difference is, let's say you want to hedge, let's say Bitcoin is at 20,000, you have 1 BTC, and you're going to the weekend, you don't want to lose any money or whatever, Bitcoin price drops down to 90k, but you hedged yourself pretty much with your 1 BTC, you went 1x short at that time. So even though it went down in $1,000 price per BTC, you didn't lose anything because your hedge made you money. Simple. Trading the inverse contracts can be challenging due to the constant exposure. So this is the example with the hedge which I just talked about. And pretty much the inverse contracts were very high popular during the BitMEX in the early Bybit days, and with the rise of FTX and Binance in 2020. Since then, the volume shifted to the linear contracts, so the USDT ones. So now most of the volume nowadays is being done on these contracts, but at some point it was done primarily on BTC USD and Ethereum USD inverse one. Now let's speak about the open interest. Open interest represents the total number of active contracts in particular market, and in simple terms it reflects the position that traders currently hold and have not yet closed. The formula is very simple. So open interest is equals total opened long positions plus total open short positions divided by 2. It's a common misconception that the market can have more buyers or more sellers. This is not accurate, because for every new position being opened, there should be the equal side being taken. So for every seller, there is a buyer. So let's break this down with an example involving 3 traders in new market where the initial open interest is 0 and the price is 100. Trader A believes the market will go up while trader B expects to decline. Trader A places a limit buy order at 100. And trader B agrees to sell at that price and it's opening a short position. While with these trades, open interest in the market increases to 1, because you have one long and one short being created. As the market climbs to 150, the third trader, trader C, decides to enter a long position. Trader A is satisfied with the $50 profit, places a sell order for one contract at 150. Trader C buys that contract, taking over the long position. Did the open interest change? No. In this scenario, one trader closed the long position while another one opened one, leaving the open interest unchanged. And as the market continues to rise, it reaches 200, trader B decides to exit his short position. Trader B places a limit buy order at 200, which trader C matches, realizing $50 profit. Now, trader B and C have closed the positions, causing open interest to drop back down to zero pretty much. And this example highlights three possible outcomes for open interest. Open interest increases when both buying and selling sides are opening new positions. Open interest decreases when both sides are closing position. Open interest remains unchanged when one side opens a position while the other side closes one. So why do asset prices fluctuate if every buyer is matched with seller? Question. Now, the answer is very simple. One of the reasons trading in most markets is relatively straightforward due to the presence of market participants who maintain delta neutral positions. These participants are known as market makers. Contrary to the popular belief, they are not involved in manipulating prices, they are instead essential for creating the liquidity for the market. So every market has spread, like in BTC you have half a dollar, 50-cent spread, right? So the market makers earn profits by capturing this spread when active traders cross between the bid and ask prices. This is an ideal situation for market makers when they can quote both buy and sell prices while collecting the spread, right? So when markets react, particularly with traders seeking to profit from downturn, prices may decline while open interest rises. This indicates that market makers and other delta neutral traders need to offload inventory to maintain their neutral positions. If traders are looking to short the market as prices drop, they enter short positions. And this is interacting with the delta neutral long positions, making the market lean directionally short. And this interaction defines how open interest behaves in real trading environments. So when price moves up or down alongside with an increase in open interest, it signals that new demand and supply is entering the market. Conversely, when markets fluctuate with decrease on open interest, suggests that traders are just closing the position, right? In the crypto space, these dynamics can lead to sharp price movements, significant drops in open interest, liquidation cascades, and I'll dive into more details later on. This is an example, right? So over here you can see this is the Solana chart, right? So over here you can see this huge increase in the open interest while prices being range bound, not moving. However, you did most likely new longs being opened, but price is not being able to move up. And as you can see over here on this move down, pretty much you remove some of these long positions, and then they start shorting at this area down here. So here you have the range and you have a move down below this range. And if you take a look at the open interest, the major increase in the open interest when you actually move down below this range. So pretty much people are trying to short the breakdown, but it turns out to be some kind of a deviation of the range. Then you reclaim the low of the range and you have a back test over here, and price continues moving up higher. You can see the decrease in open interest, so pretty much everybody that shorted this area now is getting squeezed out of the position. So let's dive into the delta, the next topic. So understanding delta. Let me just have some water because I'm getting a bit dry here. Now, understanding delta. So the term delta pretty much is the numerical difference between two quantities. So let me just hide something for a second. Yeah. Now, understanding delta. The term delta refers to the numerical difference between two quantities, and in trading particular, while analyzing footprint charts, delta represents the difference between market buys and sells. And as an example, there's 10 million market buys and 3 million market sells. The delta would be plus 7 million because this is the difference. Over here on this pretty much example, you can see new buy limit order and new buy market order. So pretty much you can see the balls are being replaced. So if you have a market order, you need to take one of these balls and put them here. So if you're pressing buy, you're taking limit order. So you're taking liquidity out of the market. What is footprint delta? So the delta displayed on the footprint chart strictly reflects market orders which must be matched by limits on the opposite side, since the market operates in both directions. And strong negative delta indicates that a large number of limit buys are being passively filled. So over here you can see aggressive reshadowing at the lows. These are limit buys which are being filled at that time. And what happens? Price moves higher. Continue, delta and open interest, right? So pretty much delta alone does not indicate whether market buys or sells you're observing represents new positions. You need to be looking at the open interest as well. And both closing of shorts and opening new longs are categorized as market buys. And the delta will reflect them in the same way. So when you analyze delta alongside open interest, you're getting a clearer picture of the majority section within a specific zone. For example, if open interest is increasing and delta shows strong buying activity, it's likely that these market buys are primarily new longs being opened rather than shorts being closed. So over here you can see you have open interest decrease and you have an increase before that. So when you have open interest decrease, price moving down, this is signifying you that you have shorts closing, right? So over here you can see another schematic. If you want, you can pause the video and look at them, observe them, and learn about them. CVD. So what is the CVD? The cumulative volume delta is an ongoing indicator that tracks the total number of completed trades at both bid and ask prices, but it monitors only market orders. It's used to identify divergences, and if you attempt to apply CVD to grasp broader market trends, things can become a bit more complex. You want to be looking at the CVD on lower term time frames, not the high term time frames. So an example, so you have CVD which is bearish over here, you have high, CVD is making high, but over here price is making low. So in this case you're having people that are limit selling and they're absorbing the market buys, and there's a difference as well. So here you can see in this example, car fuel resembles delta of a candle, right? So if you have like fuel which is equaling to 63 million delta, distance travel is gonna be 300 meters. But if the fuel is, you can have a situation where you have like the same fuel but the distance travel is less, you can assume that car B, given to all the things equal, it has had resistance causing it to travel 200 meters less. So in this first situation you do have 63 million delta. Second situation, you do have 63 million delta, but situation A, you travel 300 meters, and situation B, you travel 100. This is because there is some resistance and someone is absorbing that delta, right? And the CVD is just creating this oscillator, and it is real. It's happening right now as we speak at the current market prices. So this is the divergences. You have bearish and bullish ones. These are the examples. You can pause and you can look into them. There's a separate video of CVD on my channel. If you want to dive deeper into that, you can just go into the channel and type CVD. You're going to see my video. Same thing for the decreasing of participants or exhaustion. Now in this example, you can see I'm looking at the CVD spot and the CVD futures. So overall in this situation, we can distinguish the differences between the spot buys and the futures, so perpetual contracts. So over here you can see in this situation, this is whiffed on the 15 minutes. So you can see price aggressively moving down. And by the way, just to explain, the spot CVD is the blue one and the per futures one is the white one. So what happens over here, you can see price moving down. You finally have like a rapid move down, causing some liquidations, and then you kind of try to change the structure, right? But over here, I want you to pay attention to this section. CVD is making lower lows. CVD on the future is making lower lows, but the one on spot is making higher highs. So what this means is that futures are shorting, spot is buying. Result, move up. Funding rates. In crypto, funding has an effect on price. Perpetual swaps do not have an expiry date and they need to keep the exchange prices near the spot prices. So when it starts to reach extreme differences, funding is used to make traders want to close or open positions. And if funding is positive, people are attracted to close the short and to receive the funding. Why? Because longs pay shorts. And if funding is negative, shorts pay longs. Funding uses this to encourage traders to open or close derivative positions when there's a difference between the spot and the future prices. Now it is possible to close 1 minute before the funding because it's usually every 8 hours depending on the exchange, and you're gonna avoid paying the funding fee. Neutral funding is often 0.01, extreme 0.07 or below. Now these are examples how you can use the funding rate. So over here you can see during this low over here you had extreme negative funding. Okay, keep in mind that this is the funding rate which is happening right now. You can use the predicted funding rate as well. because the predicting is gonna tell you about the current positions, and the aggregated funding rate is telling you about the current positions. Keep in mind that there is 8 hours in delay. You can think about that as well. So yeah, you can see whenever you reach extremes into the funding, you pretty much signify a local high or a local low. Extreme highs of the funding, you move down until it normalizes. Extreme highs in the funding, you move down until it normalizes. Same thing here, right? Extreme highs in the funding, price moves down. So this is what I was talking about at the beginning of the presentation. Same thing here, this is just dived. At the exact low you have that negative funding, price comes up to normalize the funding. Thank you for watching this until the end. I'm trying to keep these things as brief as possible, just because everybody nowadays have issue with the attention span. So if you want to learn more, you can come into my Discord, you can join my private network, you can get registration at BitGet, the best centralized exchange, or if you want non-KYC trading, you can join BloFin. Links in the bio. Thank you for watching this video. I wish you a very nice day.